Class, we're going to be talking about value investing versus growth investing. We're investing for a reason. It's time to stop being broke. Being broke isn't cool. Late bills isn't cool. Debt isn't cool. And suffering isn't cool. If you want to start being broke, all right, start being lazy. Start not believing in your view. Start closing your trades early. Okay, start doing things like that if you want to stay broke. So let's talk about value investing versus growth investing and how we can actually have our money make some money. Let's jump into it. So an investment philosophy is a consistent overarching set of principles and beliefs that guide an investor's decision making process, and it dictates what to buy, and when to sell. Without a coherent philosophy, decisions become emotional and reactive, and the core tension in equity investing lies between intrinsic value, which is what a company is worth today, and future potential, which is what a company could be worth tomorrow. And by the end of this module, you guys are going to be able to understand how to articulate the foundational theories of value and growth investing, how to identify key financial metrics using each philosophy, and assess which approach aligns best with your personal financial goals and risk tolerance. And value investing is rooted in the principles laid out by Benjamin Graham. And it's often called just someone who's pretty good at investing. Okay. And it's popularized by one of his most famous students, Warren Buffett. And the core of the idea is simple, and it's buying a dollar for 50 cents. So intrinsic value, right? IV. This is the estimated actual worth of a company, and it's calculated through fundamental analysis, which is analyzing assets, earnings, and cash flow. And value investors believe that the market price often deviates from this implied volatility and intrinsic value due to irrational investor behavior. Let's talk about margin of safety, MOS. The most critical concept. This is the difference between the stock's current market price and its estimated intrinsic value. And a high MOS provides a cushion against calculation errors, business downturns, and market volatility. And the business owner mentality. Value investors think of themselves as buying a part of a business, not just trading a stock ticket. And this leads to a long-term patient holding period. So, Graham introduced the concept of Mr. Market, and it's a manic depressive business parser who shows up every day offering to buy or sell its shares at a wildly different price. A smart investor does not let Mr. Market's daily mood swings dictate their decisions. Don't let them come up to you and be like, you know what, I want to go ahead and just get into this because X, Y, and Z decisions. Make sure it's logical, okay? Don't just hop into it because of a FOMO candle, because of emotions. And remember, the compounding effect is what's going to get you guys to the profit that you want to be getting into. You got to stack up the cash, stack up the wins, keep investing in certain shares. Okay, so a smart investor, once again, does not let Mr. Market's daily mood swings dictate their decisions. They trade based off of logical and fundamental parameters, and instead use rationality to their advantage. And when buying, they're pessimistic. So buying when prices are low and selling when euphoria is in and the supply is super duper low. Okay, and that's gonna mean the demand is in, which is gonna make the prices high. So buy low, sell high. And the value of a buy. If a company has an intrinsic value estimated at $100 per share, a value investor will only consider buying if the market price is $60 or less, creating a margin of safety of over 40%. And the investor must be confident in the IV calculation in general. So formula, market price divided by the earnings per share, EPS. So the PE shows how much an investor is willing to pay for every dollar of a company's earnings. And value investors generally see stocks with a low PE ratio compared to historical averages and industry peers or the S&P 500. And a low PE suggests that the stock is currently cheap relative to its profitability. So for example, a PE of 8 means that it's going to take 8 years for the company to earn back your initial investment, assuming constant earnings, meaning that it's constantly making profit. So the price to book ratio, the PB, and the formula is going to be the market price per share divided by the book value per share. And the book value, which represents the shareholder equity, it represents the theoretical value left over if the company sold all its assets and paid all its liabilities. And the PB ratio is less than 1.0, and it indicates that the stock is selling for less than the liquidation value of its net assets, which is considered a classic deep value signal. While less common today, it's essential for financial and industrial sectors. And DE, debt to equity, measures a company's leverage, and value investors prefer a low DE ratio, as high debt is going to be a major source of risk and can erode the margin of safety. So free cash flow, right? FCF. Free cash flow is the cash that a company generates after accounting for cash outflows to support operations and maintain its capital assets. Strong, consistent, and FCF is vital as it fuels dividends, stock buybacks, debt repayment, and the things that ultimately justify intrinsic value and the things that are going to cause a stock to go in an upwards direction. So pay attention to all these things, okay? Look at the ratios, see what's going to be worth investing into, and scan each of the fundamentals and know each of them things mean before you invest, okay? You can see quality companies that are temporarily mispriced and not companies that are structurally flawed, okay? Because over time, that'll lead into a downward decline of money for the most part, okay? They're not helping anybody. They're not putting any value into society. They're not making people smile. So it's not going to be a worthwhile company. It's not going to be something that is going to put some future value. Okay. So there's no point in investing to things like that. We're here to make some cash. We're here to stack some cash. We got people to take care of, houses to buy, land to get. Okay. We got to be stacking this cash and getting to it, inshallah. So there's some pros. There's the lower downside risk. The margin of safety acts as a buffer. And by buying below the intrinsic value, the potential for further significant losses is theoretically reduced. And psychological calm. Value investing encourages patience and detachment from daily market noise, reducing emotional trading errors. So, in dividend income, value stocks are often mature, and profitable companies return capital to shareholders via constant dividend payment. Why? Because the company's making so much money. They're going to be like, you know what? You guys can go ahead and have some money back. Here you go. And that's what a dividend is. Patience is going to be required, all right? It can take years for the market to realize the stock's true value. And that's okay, okay? Be patient, keep stacking cash, keep grinding hard, keep waking up, praying to God, and putting your full force into whatever, your business, your work. Keep stacking cash, okay? Keep going hard, trying to protect and provide for yourself and your family, okay? Keep stacking cash, stay down, get into stack mode. Don't buy that whip just yet. Don't buy those clothes just yet, okay? You don't gotta fill up the cologne cabinet full of X, Y, and Z right now. Stay down, okay? Take your time, build real wealth, okay? So you can take care of your family whenever it's time, okay? You're gonna be the one who can handle the hard times, okay? Why? Because you were in stack mode, you didn't give up, and you were staying down. And the value trap, this is the greatest risk. And a stock looks cheap, right? Low P and low PV, but it's cheap for a valid reason, such as a fatally flawed business model, disruptive technology, or poor management, and the value never materializes. And missing out on innovation. By focusing on established, mature businesses, value investors often overlook high growth companies that are changing the world. And the ideal value investor is patient, contrarian, analytical, and possesses strong emotional discipline. They thrive deep on research and are comfortable standing alone against popular market sentiments. So, foundation principles. Growth investing focuses on companies that exhibit above average rates of expansion in revenue and earnings, often driven by new technology, market expansion, or innovative business models. And the philosophy was philosophized by investors like T. Rowe Price and Philip Fisher, and has a focus on momentum. Growth investors prioritize future earnings and potential over current valuation metrics. They're willing to pay a high price today for the promise of massive earnings tomorrow. And disruptive innovation. Some key characteristics include a high rate of sales growth, a strong competitive advantage, a moat, and a rapidly expanding industry, and a focus on reinvesting all profits back into the business for continued scaling. Okay, and ignore current profitability. It's common for high growth companies to report low or negative earnings, okay, just because they're getting their feet off the ground. Okay, they're letting the sales come in, letting the customers come in. Doesn't mean that the company is not worth nothing. And thus a high PE ratio is going to be involved into that as they invest heavily into R&D, marketing, infrastructure, and trying to make the company bigger. So then their profit margin is going to be a lot bigger. Okay. So while a value investor seeks a stock trading at $60, that should be $100. A growth investor seeks a stock trading at $100 that they believe will be worth $500 in 5 years. Okay. They're concerned with the trajectory of the business, not its current snapshot. Is it going to be putting smile on people's faces? Okay. That's going to be the number one telltale sign to know if a business is going to be successful or not. How much is it affecting people's lives? Okay. And a growth buy, let's talk about it. So let's say a software company is losing money today, has a negative EPS, but its recurring revenue is growing by 50% annually. A growth investor buys based on the expectation that once the company achieves critical mass and stops aggressively spending, the profits will be enormous and the stock price will multiply several times over. So focus. Investors primarily look at year-over-year revenue, growth, and earnings per share, the EPS growth, and consistent growth above 15 to 20% is often the benchmark for a true growth stock. And quarterly acceleration in these metrics is a major bullish signal. So let's talk about the law of large numbers. Growth investors must always assess how long a company can sustain high growth rates, as it becomes exponential harder as the company scales. And that's the law of large numbers. And we'll talk about the PE ratio, divided by the annual EPS growth rate. That's a percentage. The PEG ratio attempts to harmonize PE and growth rate. And the PEG ratio of 1.0 or less is often considered a fair value for a growth stock. And it suggests that the price being paid is reasonable and relative to the expected growth. And if a stock has a PE of 30 and is growing earnings at 30%, then it has a PEG of 1.0. So high growth, recurring revenue. High growth software and subscription companies are highly valued for their predictable recurring revenue streams. For example, software as service or SaaS. And TAM. TAM is going to be the total potential size of the market and that the company is targeting. The bigger the TAM, the longer the company can maintain hypergrowth, and investors seek companies with small current market penetration but colossal TAM. And TAM stands for total addressable market. So principle. Growth investors are fundamental, betting on future performance and disruptive power in an expanding market, looking to make money constantly. So advantages: potential for explosive returns. The possibility of 5 or 10x returns in a shorter time frame is the primary draw, and compound growth is exponential. And exposure to innovation. Investors gain exposure to the companies driving technological change and societal evolution. And the simplicity of thesis. The core thesis is often easier to articulate, and this company is winning in a massive growing market. And the cons: extreme volatility. High expectations lead to steep sell-offs, and if the company misses even minor earnings targets, these stocks are vulnerable to economic downturns and interest rate hikes. And valuation risk. Paying a premium for growth means the investor must be right about both the growth rate and the sustainability. If growth slows, the stock can fall dramatically. And the lack of dividends. Growth companies typically reinvest all the cash flow, meaning that the investor receives no current income at all. So the ideal growth investor is risk tolerant, technological savvy, forward-looking, and comfortable with volatility. They seek to capitalize on the long-term trends and accept the risk that many investments will fail, provided the successful ones generate outsized returns. So bridging the gap. The GARP philosophy, famously employed by Peter Lynch, it seeks to combine the best aspects of both disciplines. And a GARP investor looks for companies that are exhibiting consistent above average growth, but are not trading at exorbitant, speculative valuations are going to be involved in them. And a GARP criteria, it's really the best of both worlds. GARP, it stands for growth at reasonable price. A growth at reasonable price stock often has a PE ratio that is only slightly higher than the overall market, but its EPS growth rate is slightly higher, and it blends the safety of a modest valuation with the upside of strong business expansion. And the PEG ratio is the primary tool used by GARP investors. And the GARP investor profile, consistent growth. It seeks stable, sustainable growth, for example, 10 to 20% per year, rather than volatile, exponential growth. And the focus on quality. It prefers companies with strong balance sheets, high returns on equity, and strong free cash flow. And it's hallmarks of a fundamentally sound business. And risk mitigation. You can see things like the PE and PEG metrics, which you can use to evaluate and to avoid grossly overpriced stocks, thereby mitigating the risk inherent in pure growth investing. So you don't be buying things at all-time highs, stuff like that too. So insight. GARP is perhaps the most practical strategy, once again, growth at a reasonable price for the average long-term investor, providing a path to the market and beating returns without taking on undue speculative risk for no reason at all. So choosing the right approach is less about what's right and what's wrong, and what about aligns with your personal goals. Are you a family? Are you a guy with someone with kids? Are you a woman with someone with kids? Are you by yourself? You just have a partner. Can you go a little bit more heavy with your investments? Are you trying to play it safer with maybe dividends? So let me know what you guys are doing in the comments below. So your time horizon, It's going to be 10 years if you're value investing, but you prioritize capital preservation. Your risk tolerance is going to be low to moderate, and you dislike volatility. And your goal is going to be to generate current income via dividends and stable compounded returns, investing in things like SPY, QQQ, and things like that, slow movers that are very consistent. And you enjoy deep analytical research into financial statements to figure out the best ratios to see what's going to pay you guys the most out. And consider growth investing if your time horizon is long and you're seeking to maximize capital appreciation. And then maybe you might want to go ahead and invest into some value stuff, dividends, after you get some day trading, futures profit, swing trading profit, whatever. And your risk tolerance is going to be higher in this scenario. And if you're comfortable with significant drawdowns, and your goal is to capture exponential returns from market disrupting businesses, and you're technological informed and enjoy following market trends and innovation. So, have a diversified portfolio, okay? I recommend you guys having a long-term portfolio and then you guys having a short-term portfolio, okay? Also, because the taxes are going to be different too. If you're holding a trade for over 1 year, taxes are going to be subject to some long-term tax benefits versus the short-term tax benefits if you sell before a year, okay? So decide what's best for you, okay? Invest in a smart way. Keep this capital. We're building wealth for ourselves, our families, our loved ones, making sure everyone can be taken care of, making sure everyone can be protected and provided for, because we're being disciplined, because we're going hard, and because we're pushing forward. All right. Don't be in your head. Don't let anything stop you guys. Stay prayed up to God. Keep grinding and head over to StackMODE.net if you want to learn how to be disciplined and how to invest. Catch you in the next one.